Hey YouTube, welcome back to Alpha Finance. Today I want to cover 401k plans. So we want to talk about everything that you would need to know about a 401k plan so that you can make an assessment about whether or not these financial vehicles are appropriate and efficient to help you meet your financial goals and objectives. Before we get into the content, remember to like, share, and subscribe if you find this information helpful. Okay, so let's start at the beginning. The 401k has been around really since the late 70s, and it's named after a portion of the IRS tax code that is exercised when one is used. It's named after IRC, Internal Revenue Code, Section 401k. IRC Section 401k states something like this: an employee can avoid taxation on some of their income if they elect to have that income in the form of deferred compensation rather than direct pay. So what does that mean? So let's break it down. What does compensation mean? Compensation just means money, right? A way that you get paid. What does deferred mean? Deferred means to withdraw or withhold until a specified date or time, right? So if we put it together, it means that you can have some of your compensation, money that you are owed, and you can choose to realize that income later rather than now. And the result of that is that you can avoid taxation on that money today, even though you earned the money today, right? Choosing to defer your compensation means that you will be able to put away more money today so that you can grow it into a bigger pile of money tomorrow. Due to the tax breaks that allow people to put more money away for retirement, 401ks have become very popular over the last couple of decades. Today, they're the most popular type of retirement account there is. Okay, so who can have a 401k plan? Not everyone can have one, unfortunately. A 401k plan is an employer-sponsored retirement plan. It means that you have to work for a company that offers the 401k plan as a part of its benefits package. Okay, so let's talk about the rules for 401k usage. So in the beginning, right, I said that a 401k is a type of account. So let's relate it to something that we understand, like let's say a bank account, right? So you have a bank account at a normal bank, like a checking account or a savings account or something like that, at one of your local bank branches, let's say Chase or Bank of America or whoever you happen to bank with. If you have a normal bank account, right, you can walk into a branch or go online at any time and you can make a contribution, right, a deposit into the account, or you can make a withdrawal. You can take the money that's in the account and you can take it out of the account, right? 401ks work very similarly to bank accounts in the sense that you can keep cash in them, but in addition to cash, your 401k can also be used to hold assets like stocks and bonds as well as cash. And so in addition to that, your 401k has special tax advantages that a normal bank account does not have. So the government has bestowed the power upon you to use these tax advantages to however you see fit. But in exchange, the government says, I'm going to give you these tax benefits, but you have to follow the special rules that I have put into place that I believe as the federal government will allow the accounts to best do what I intend them to do, which is allow people to save for a standard retirement, right? So you can't just go into a 401k and grab the money when you want to grab it like you would with a normal bank account. And you can't put infinite amounts of money in the account like you could in theory with a bank account if you had the money to do so. So we're going to go over how the rules are different between a traditional 401k and what you consider to be a normal bank account, right? So first, let's talk about contribution limits. So like I said earlier, you can't put an infinite amount of money in a traditional 401k. There's a limit to how much you can put in a traditional 401k in a given year. As of the recording of this video is now 2023. The annual contribution limit for a 401k is $22,500. So that's the total amount of money that you could in theory, put into a 401k in a single tax year. So that limit is fixed for the year. It doesn't change in the given calendar year. In addition to this $22,500 There's a specific group of people who may be able to contribute slightly more than that. If you're in the 50 and over club, you can make what's known as catch-up contributions. So the idea for catch-up contributions is if you want to put in more money than the 22,500 limit, and you have the money to do so, right? You can contribute up to an extra $7,500 for the 2023 tax year. So if you're under age 50, your contribution limit is $22,500. If you're 50 and over, then your contribution limit is $22,500 plus $7,500 for a total of $30,000. Can you have multiple 401ks and contribute to them both? Yes, you can. If you have, as long as the combined amount that you contribute to the 401ks does not exceed the annual limit of $22,500, except for the one exception that I talked about earlier, if you're age 50 and over. So if you, in theory, were to start with a company at the beginning of a tax year, you have a 401k, you contribute to it, you put $5,000 in, let's say. Then you leave that company, you go to a different company, you have a different 401k plan. You open a 401k plan there, you contribute to that one. You can contribute up to $22,500 minus $5,000, right? Which would be once you put the two contribution limits for those two together, you'd have the total amount for that tax year of $22,500. Okay, so that's rule number one, is contribution limits. Number two is special stuff, right? So you could have what's known as a rollover for 401ks. So in the rollover case, you can basically take the monies in the 401k and you can move it to a different type of tax investment vehicle. I'm going to have a completely video separate for 401k rollovers and describing how that works, but I just wanted to mention it here quickly. Withdrawals. So when can you actually withdraw from a 401k, right? So these are the common rules. So remember I said before, if you have a bank account, you can walk into a bank, you can withdraw money out of the bank account. You don't need to ask anybody to do that. You don't need to tell them why. You don't need to specify. There's no limits on how much you can take out as long as the money is in there. 401ks are not like that. So as I'll go into in more detail in the cons, there is a specific age beginning at which you can start to take money out once you put money in. You can put money in at any age. But you can only remove money after the age of 59 and a half, right? So once you're 59 years old in 6 months, then you can start removing money from the 401k. Now you can actually remove money before that, but if you do that, you're going to pay a 10% penalty of whatever you pull out. So let's say, for example, you pull out $40,000, right? The federal government is going to take $4,000 off the top, right? 10% of 40,000. And they're going to take that as a penalty. So now you got, 36,000 left, right? Which is 40,000 minus 4,000. Not to mention, consider that when you do pull money out of a 401k, be sure to actually plan how much you're going to pull out and when you're going to pull out and for what reason. Because even when you do pull out that remaining 36,000 of that 40,000 after that penalty, you still have to pay federal income taxes on that money. So you're not even going to come home with 36,000. It's going to be 40,000 minus the penalty, minus federal income tax. So that's one thing to keep in mind, is that when you put money into a 401k, consider that that money may be in there for decades and you can't necessarily pull it out. So that's the age for a standard withdrawal from a 401k is 59 and a half. So let this be kind of somewhat of a lesson that consider that whatever monies you put into the account are really considered to be a long-term investment and a well thought out idea of how to put the money in there and for how long and for what purpose. Okay, so I want to start the conversation about the pros and cons of using 401ks. There's a number of different pros and cons. There's pros and cons to any type of investment vehicle that you use. Let's look at the pros first. Okay, so the pros. Pro number one is that 401k plans are the most popular way for Americans to have access to the financial markets. So what do I mean when I say the financial markets? Essentially, I'm talking about the stock market, the bond market, and any other markets where people can buy and sell and trade assets. About half of all Americans own stock of some kind in some form. Now, the percentage of Americans that own stock outside of a 401k plan is like 14 or 15% according to research from some Pew's data that I've seen. So what that means is that about half the country is invested in stocks. And about 1 in 10 Americans is invested in stocks outside of 401k plans. So what that means is that the accessibility of 401k plans has significantly allowed people to invest in stocks that otherwise would not be able to invest in stocks. And being able to invest in stocks is a significant advantage for people as they try to save for their retirements. So that's certainly an advantage for the 401k plan overall, and for Americans in general who want to plan and save and meet their investment goals and objectives. As you're probably aware, a very high percentage of the stock is owned by a very small percentage of the people. So giving individual people, everyday people, access to the public markets has been a good advantage for this country and for any other country that has similar plans such as the 401k. Okay, pro number 2, pre-tax advantages, right? Tax breaks. I'm really gonna harp this one home. Is the 401k is used for deferred compensation, means that you can take money that you otherwise would have had to pay taxes on, and you can take that money, put it in the account, and you can invest it and grow your money. So not only are you able to invest your money that you could use to grow your wealth long term, you can also use the money the government would have taken in the account, and you can grow that money too, and potentially you could keep all of it depending on how you structure your taxes down the line. Right, so the ability to have those tax advantages, not only does it allow you to grow more money than you otherwise would have been able to grow, but you can also decide when to take advantage of those tax advantages and how much, right? More options is always better than less. Okay, pro number 3, automated contributions and investments. So this is a big one, right? A lot of people, their financial investments are not necessarily the most important thing to them, and that's okay. Life has a lot of different pieces to it. There's certainly other things that are more important than how much of your investments you're buying and in what allocations, right? So with most 401k plans, you can do what's known as an automated contribution, which means that you can pre-select how much money you want taken out of your base pay to go into the 401k plan. And then inside your 401k plan elections, you can decide where that money goes. You can put it into stocks or bonds or a stock bond mix. It's very customizable, and it ensures that people do continue to save over the course of their working years towards their eventual retirement goals. You can also allocate changes that allow you to increase your contributions over time over the years to account for inflation and increases in pay and stuff like that. So that's a good advantage for most people. Okay, pro number 4, 401k matching. Anybody that knows me knows that I will go to the moon and back on this particular issue. I am of the opinion that the best way to get anybody to do something is to pay them to do it. And that's essentially what a 401k match is. So a 401k match is essentially, let's say you decide to use this advice and you decide to contribute to a 401k plan. You defer some of your income, let's say $2,000 over the course of a year. What a 401k match is that your employer will also take a separate $2,000 and put it into the account. So at the end of the year, you don't have $2,000 in the account, you have $4,000 in the account. Now that would be an example of what's known as a dollar for dollar match. Not every company that offers a 401k plan does a dollar for dollar match. Every company does their plan a little bit differently. You'd have to look at your plan documents to see exactly what your match criteria are. And that also goes without saying that your match doesn't have to be $2,000. Typically, it's a percentage of your compensation. So 2% of your salary, 3% of your salary, 4%, 5%, 6%. I've seen 7%. I've seen numbers even higher than that. So if your employer is going to pay you 6 or 7% to put money into the 401k plan, so let's say you make, I'm just throwing numbers out there, let's say you make $50K and you have a 5% match. What is that? $2,500 over the course of a year. I think that's quick math. Check me on that. But you put in $2,500, they put in $2,500, now you got $5,000. You do that every year. Let's say you do that for 10 years, that's $5,000 times 10, that's $50,000. And that's a pretty big deal to me. And that's an advantage that I see. Okay, those were the pros that I could think of. I see myself as a fair arbiter of the truth. So I said I'd give you the pros and cons. So I'm now prepared to give you the cons. Here are the cons that I believe to be present when using a 401k account. Okay, so disadvantage number one would be access to public markets. And I know what you might be saying. So didn't you say that access to public markets was actually a good thing in the pro section? It's like, yes, but let me qualify that. So consider just the U.S. exchanges for me. I'm in the United States. The two largest exchanges in the United States are the NASDAQ and the New York Stock Exchange. So if you just look at the individual stocks that you could buy on just those exchanges, it's probably like over 5,000 individual stocks that you could buy. And that doesn't include all the bonds you could buy. It doesn't include the options. It doesn't include all the ETFs you could buy. And then you go outside the United States, you have different exchanges, stock exchanges in Europe and in Asia. So when you add all that stuff together, you're probably talking tens of thousands of different things that you could buy. But when you consider most 401ks, you probably have maybe 8 to 10 things that you could buy in total. So you take this entire market and you distill it down into just a handful of different things that you could buy. Typically, the standard 401k will have a couple of equity mutual funds. Some of them maybe follow the S&P 500 or something like that. A couple of bond mutual funds or ETFs. Maybe an international one or two if you're lucky. You'll have some what they call mixed funds that maybe have stocks and bonds in them, and then maybe some target date funds, which automatically adjust over time. They adjust the stock and bond allocations over time, depending on age. Those have their issues too. But you basically took the entire world and you distilled it down to 8 things. And there are some advantages in that, right? Because most people, they're not sure what they want to buy. And a large number of choices can overwhelm. But if you are a person that maybe wanted to have more control over your investments in search of, let's say, higher returns, or in search of, let's say, better risk-adjusted returns, that might be a better way to say it, right? You may think, or you may decide to find options that have better diversification strategies than what's available to you in a normal 401k. You don't have access to any of the assets that may allow you to do that. So that's a disadvantage. Now, you may be wondering why this is the case. So for the most part, individual companies have a lot of discretion with regards to how they decide what goes into their 401k plans, what you are available to purchase with your monies that you put in there. And collectively, they have decided that it is more important to protect you from yourself than to give you the opportunity to make choices for yourself. My personal philosophy is that more choices is always better. It doesn't matter whether you use the choices or not, but the fact that they're there gives you more options, and more options is always better than not having the options and then not being able to do something that you might want to do later on simply because that choice is not available to you. So yeah, I consider that to be a downside. It's not a really significant one for most people, but it is a downside nonetheless. Okay, second con or downside would be liquidity. So liquidity is just whether or not you have access to the money, right? So liquid funds means that you can easily transform the assets into cash, and that cash can be used to buy goods and services. So any monies that goes into a 401k is basically in there, and for the most part it can't come out. There are a couple of exceptions to this, and I'll talk about those exceptions in a separate video. I call them the special rules that nobody really uses, but they exist. They're in the IRS code, and it's just completely legal to use them. So, but to continue on our main discussion, for the most part, once the money is in the 401k, it really cannot come out, only under a very special set of circumstances. The most common circumstance is that if you meet the age requirement for the standard retirement for the account, which is 59 and a half. So if you try to withdraw money from a 401k before age 59 and a half, you will have to pay a 10% penalty on whatever you take out, in addition to whatever the taxes are. So that could be pretty substantial, and it's a significant deterrent for most people. And so most people don't pull money up out of their 401ks. What most people will do instead is they'll take what's known as a 401k loan against the account, and that's not taxable because it's not income. Debt is not income. You're taking a loan from yourself and you have to pay it back. So all that is kind of a weird dynamic. So the way that I consider it is the money's in there, you can't take it out. So the reason why I consider this to be a con, it could be a pro and a con depending on how you think about it. But again, my perspective is more options is better. Just because I can take the money out doesn't mean that I will, doesn't mean that I should, but it'd be good if I could, and you can't. So like, for example, I know a lot of people who have a lot of money in their 401ks, maybe tens of thousands, hundreds of thousands, maybe even more than that. And so by most people's standards of wealth, right, these people would be considered very well off. But when you look at their lives and you look at the financial situations that they find themselves in, they're in the same financial situations as people that don't have anything in their 401ks or not very much at all. Why? Because ultimately what matters is your cash flow and your liquid wealth. That's the money you have access to at any given time. So you could have $1 million in the 401k, but if the bills are tight, then you just as broke as everybody else. That's kind of the way that I see it, because that's the reality. So I do consider liquidity to be a disadvantage, although it can be a significant deterrent, and that can work positively in the way that people would traditionally use the accounts. People would take the money out if they could, so the fact that they can't might be good overall for most people, but the fact that you can't, I think, is a disadvantage. The last thing I'll say about liquidity is just because the account is illiquid and you can't take the money out until age 59 and a half doesn't necessarily mean that you shouldn't put your money in a 401k. What it does mean is that there's a number of different financial considerations that have to be made to determine whether or not that is the correct place or the place that is most optimal for you to put that particular amount of money. The big picture to me is this, right? Like, if you put all your money in the 401k, what you're essentially saying is that I'm going to have no money until 59 and a half, right? Now, depending on your particular financial plan, financial strategy, that may be perfectly fine. You may not have any need to have money before 59 and a half, which in that case, it doesn't matter. But if you think you might need that money before then that may not be the best place. So yeah, I consider that a disadvantage. Okay, so potential 401k con number 3, potentially high fees. So the average 401k has significantly higher fees than other comparable investment vehicle options that you could choose from. Most people end up paying somewhere between 0.5% to 1% in fees per year. That's kind of like at a minimum. Some people pay way more than that. But a 1% fee, what that essentially would mean is that at the end of every year, they look at the balance of your 401k, they calculate 1% of whatever the balance is, and then they take that money out as payment for their fees. Now, I know what you might be saying, well, a 1% withdrawal or 1% difference can't really be that significant, can it? Well, it is, and it will be very significant. I actually have some numbers pulled up on my laptop. So I put in a pretend scenario with one of the compound interest calculators that you can find these online. I'll link a link to them in the description if you want to use them yourself and play with the numbers. But I had an initial investment starting at $50,000 with no monthly contribution, compounded for 30 years at 8%, right? 8% is pretty nominal as far as average returns for the stock market and such like that. So it's not a crazy number. That's a very realistic number, 8%. And over a 30-year period, starting with $50,000 at 8%, you'd end up with $503,132.84. So about $500,000. So that's at 8% compounded. So what would it be if it was at 7% instead of 8%? Because that's essentially what a 1% annual fee does. It basically takes your annual returns down from 8% to 7%. So at 7%, instead of ending up with $503,000, you end up with $380,612.75. That's about a 25% decrease. It's got to be at least over $100,000, $120,000. Yeah, about $120,000 difference. And that's just with a 1% difference in fees. 1% is a lot. So any money that you consider putting in a 401k, you have to consider that high fees will basically eliminate any tax benefits that you probably were going to get from the account. So it's important that you know which type of 401ks you're invested in. Some 401ks are good, some are not so good. Anything that has like a 1% fee or greater than that, I wouldn't put my money in it unless somebody was gonna, unless there's some other type of incentive to get you to contribute to the account, like an employer match or something like that, like I mentioned earlier. And again, that's like a $120,000 difference, and that's just with positive exponential growth, right? That's just going up at 8% every year, right? What if you actually had down years during that period, which you normally would have in a real scenario? You'll have some up years, you'll have some down years. Now they take that 1% fee whether your investments are up or down. And if your investments are up, they take 1%. Then they're taking some of your gains, okay? But if your investment portfolio is down, then they're taking some of your principal. And so that's going to hurt your compounding growth going forward. So in a real scenario, it wouldn't be like $120,000 difference. It'd probably actually be much worse. So it is something that you really want to consider when you decide how much money is to put into your 401k and for what reason. Yeah, guys, the 401k fee thing is very important. So I remember I actually used to work for a company that had a 2% annual fee for the 401k. So if you thought 1% was bad, losing 25% of your of the value of your would-be value of the account after 30 years, $120,000 difference, starting with $50,000. 2% annual fee is even worse, and it's more negative than you're probably thinking because you're not thinking in terms of exponential growth and decay. I actually had the numbers down for 2% annual fee too. So that basically takes your annualized return from 8%, which was the original case, right? That was like $500,000 of compound growth, starting with $50,000 over 30 years. Then at 7%, it was $380,000 at the end. At 6%, it's like $280,000 or something like that. You lose like another $100,000 on top of what you already lost with the 7% case. So you certainly want to be careful as far as 401k fees are concerned. If you don't know what your 401k fees are, I would contact your HR department and ask them what the fees are. They probably don't know, honestly. But all the numbers have to be in your plan documents provided with your 401k plan by law. And if you feel like, going through that with a fine-tooth comb to figure out what the fees are, that might actually be a good idea for any additional monies you're considering putting into the account beyond your 401k match. So that's at least my opinion of it. The laws have changed recently. Those numbers may be a little bit easier to find than they have been historically, but it is something that you certainly want to pay attention to. 401k fees tend to be higher than other comparable vehicles that you could invest in because 401ks are how most people save for retirement, so they're susceptible to a lot of regulatory oversight, and that regulatory oversight results in higher administrative fees that you have to pay for. Okay, so 401k con number 4. This is a special rule. We talked about the standard rules earlier, but this one's kind of a special rule, so I put it under the con section because it's definitely a con. Is RMDs. So RMD stands for required minimum distributions. So essentially what that is if you happen to be so lucky enough to be able to put enough money into your 401k where you actually don't need it, the government forces you to take money out of the account once you reach a certain age. So right now, after the Secures Act got passed in 2019, that current age is now 72 years of age. So what happens is at age 72, they require you to take a certain amount of money out of the account every year from that point forward. So the way that they'll calculate is that the IRS basically has like these mortuary tables that are supposed to tell them how long people are expected to live. And then they take that number and then how much money is in your account. And then they, based on those two numbers, they tell you how much you have to take out of the account every year, such that the account is expected to be empty by the time you're expected to pass away. For a typical person, this ends up being typically around 3 to 4% of the account balance per year after they turn 72. So you can imagine a scenario where, let's say you're 72 or something like that, and everything's perfectly fine. You know, you think that you have this money in your 401k, you have no liquidity issues, you got plenty of money, and you still have your money in your 401k, you haven't touched it. And you're thinking that I'll just let it grow. Maybe I'll give it to charity, or I'll give it to my kids, or whatever. I'll just allow it to continue to compound without having the tax drag on it. So you just leave it alone. The government says, nope, we need that tax revenue. So regardless of what your financial situation is, even if it would result in you taking a big tax liability that you otherwise wouldn't take, they're still going to make you take the distribution. So like I've been saying throughout this video, it's always better to have more options than less. And once you get to a certain age, the government will force you to take money out, and you will get a big slap on the wrist as far as taxes are concerned, and that could really eat into some people's long-term plans. So that is definitely a con. Okay, so I'm gonna give you a bonus con, number 5. This one is essentially what it surmises to is tax uncertainty. So this one's a kind of tricky one. So we'll kind of go over it a bit here. I'll just kind of gloss over it here, and I'll have a separate video specifically that deals with the tax treatment and how these things work. So essentially what's happening is, if you have a traditional 401k, right, it's a pre-tax account, right? That means that the money comes out before taxes are come out, right? So the money that's in the account is the pre-taxed amount of your income that you've contributed to the account. What you're essentially betting is that the tax rates that you avoided today when you put the money into the account are higher than the tax rates that you expect to pull the money out in later on, right? So if tax rates are up here and you avoid this tax rate, that's good. And then if you take the money out and tax rates are down here, then that's good, because the difference between here and here is gains for you, right? They call that, well, I call it tax arbitrage. And so it can add to your returns over time if you plan this well in your financial planning. And I'll have a separate video about tax arbitrage, but the general idea, right, is that there's some underlying uncertainty there, because you're betting that you're avoiding this tax rate and that you're going to come out at this one. But what if you're avoiding this one and you come out at this one? So what if when you actually take the money out of the account, you're at a higher tax rate than the tax rate that you avoided? That means that you'll lose money that you otherwise would not have lost, right? So that would be a downside. So there's some betting going on, that you're betting that tax rates will go down relative to what they were when you avoided the tax rates in the first place. And there's no way you could know that. There's no way that you could know that tax rates are going to go up or down. So there's some built-in uncertainty into pre-tax accounts. Now, of course, you can just avoid the taxes altogether. You can avoid this tax rate, and the tax rate you end up paying is zero. So you're always going to get some type of arbitrage between what you would have paid and what you ended up paying, which is nothing. You can set up your situation to be that too, and we'll talk about that in the video. I've already seen it. People do it. I've already seen it in the tax law. You can 100% do this, and we'll talk about that. But one thing that I do want to say is that it seems unlikely that tax rates will go down, right? Tax rates, as far as historically are concerned, tax rates are near the lowest they've ever been for a long time. And the country has more debt. You know, the country has like, what, $32 trillion in debt, right? The probability that tax rates will go down from here, I think, is kind of low. It's much more likely that taxes will go up in the future, but again, nobody knows what will happen, right? And so that's one of the most difficult things to plan for as far as financial planning and strategy is concerned, is uncertainty. So anytime you use a pre-tax account, you're automatically building uncertainty into your financial plan, and that automatically is a downside because it's something that's difficult to account for. Okay, so we've talked about a lot of stuff, right? We've talked about what a 401k is, how you get one, what are the special rules that you need to abide by in order to use one. We've talked about the pros and the cons of using such an account, right? We've talked a little bit about tax treatment, and now I want to leave you guys with basically, which is my final thoughts about who the 401k account might be best for. Now, don't get me wrong, I am not saying that if you do not belong to one of the groups that I'm about to say, that means that you should not contribute to one. That is not what I'm saying. What I am saying is that, in my opinion, there are certain groups of people where it makes a lot of sense for them to contribute to 401ks as opposed to other options, because their unique set of circumstances would either mitigate a lot of the disadvantages or would take an extreme advantage over the strengths of 401ks. So we'll get into that group next. Right, but before I do that, I'll say this as well. So I haven't actually made a judgment on whether or not the 401k is good or bad, because it's not. Right, the 401k is just a tool, and that tool has pros and cons just like any other potential account that you could have or investment option that you could have. What's important is to know what the pros and cons are so you can make a choice about whether or not the pros outweigh the cons for your particular situation. I will be having a set of videos where I compare the 401k to other types of investment vehicles / accounts that you could use, and when I would suggest using one versus another in particular situations, and then also comparing them head to head to see if there's any clear options for which one should be picked under certain scenarios. Okay, next I want to get into the groups of people who would have the most to benefit from using a traditional 401k. So I want to make it very clear that if you happen to not be in one of the specific groups that I named, that does not mean that you have nothing to benefit from using a traditional 401k. It simply means that those people who I name in these specific groups have an outsized amount to gain relative to other people compared to the other investment options that they have besides the traditional 401k. So let's get into the groups of people who, in my opinion, have a lot to gain from using a traditional 401k relative to other choices. And using a traditional 401k is mostly like a layup for these people unless they have a specific financial situation that would be considered an exception. So group number one would be people who are in very high tax brackets. So when the 401k was created in the early 80s, it was originally created to be a tax shelter for high income individuals. So even though the 401k's purpose has somewhat changed over the last several decades, it's still true that a 401k can be used to shelter incomes at the higher tax brackets. So if you're a person and you're a wage earner, let's say, and you're paying 5, maybe 6 figures in taxes, you can actually defer those taxes into the 401k and avoid taxation on those higher brackets so that you can save money. Another exception that kind of also falls into this group is if you're a person who has different streams of income, and some of those income streams may be tax efficient and some may not be tax efficient. We'll talk about tax efficiency in a different video, but the general idea here is that you have this one tool potentially that you could use to avoid taxation on assets that would normally be taxed at higher rates. There are some asset sources that are going to be taxed at more tax inefficient rates and some that are taxed at more efficient rates, and we'll talk about that in a different video. But in general, people who find themselves in higher tax brackets, specifically relative to the tax brackets that they would expect to be in when they expect to pull the money out. For most people, that would be a standard retirement, but you could pull the money out for any reason once you reach the standard retirement age. Or you decide to do a rollover, and that's another situational exception that we'll talk about in a different video. But that's group number one. People who are in high tax brackets that have some reason or some motivation for wanting to avoid taxes on either inefficient income or high tax brackets. The second group of people who, in my opinion, have a lot to gain from using a traditional 401k relative to other methods would be people who are close, or individuals who are close to retirement. So it doesn't necessarily mean that they get a significant tax advantage. So let me kind of explain the benefits for this particular group. So when we were talking about the cons of a 401k, one of them was liquidity, right? The fact that once you put money in, you can't take it out until 59 and a half. And so if let's say you're 30 years old, then you can't pull the money out without penalty for 30 years, right? That's a con, right? That's something you have to plan for. It's not necessarily something that can't be planned for, but it is something you'd have to consider. But let's say you're 55 and you can take the money out at 59 and a half. That's a complete, right? The second person only has to wait 5 years, less than 5 years, whereas person number one has to wait for 30. So the liquidity disadvantage goes away for people who are very close to meeting the minimum amount of liquidity requirements to make withdrawals. Also, people who are very close to retirement, they have better scope of what their retirement is expected to look like, right? One of the other cons was that if you utilize a pre-tax account, there's some uncertainty involving the taxes that you will be expected to pay when you pull the money out. Now, if let's say you're 30 years old, you put the money in, you avoid the tax bracket that you're in at that time, and now you're going to take the money out 30 years later at a different bracket. You don't know what that tax bracket is going to be. One, because you don't know what your necessary income is going to be in retirement. But two, you don't know if Congress is going to change the tax brackets or not. And so all of these things are things that could potentially change how much taxes are owed when the money is pulled out. But if you're very close, a lot could change in 30 years, right? But if you're very close to retirement, there is a much higher likelihood that you have more of the facts about what exactly you need your income to be in order to have the retirement you want, and it's less likely that big tax changes are going to happen very quickly in that small period of time. So that eliminates another one of the cons that people could potentially run into when using a traditional 401k relative to other options. One other thing I'll mention about special group number 2, i.e. the group that is very close to retirement, is it is very likely, right? If your situation is comparable to most people tend to earn more money as they get older. So the probability that you're earning the most money that you'll ever earn when you're in your 50s and 60s relative to when you were in your 20s and 30s is fairly high. So you fall into this group where you intersect a little bit with group number 1, the high tax bracket group, right? In general, right, people who are in high tax brackets want to avoid the high tax brackets by deferring that income into a 401k. But also, this applies to people who have high incomes relative to the income that they expect to have in retirement. I mentioned this a little bit earlier, but it's a little bit more clear in this example, right? If you're a person and you making, let's say, $60K, in your 50s and 60s, but you only expect to need, let's say, $40K in retirement, then it becomes more clear that you're going to be in a lower tax bracket relative to your income today. And so then it would be in your best interest, likely, to contribute to a 401k, get that deferred income on that additional income that's in the next bracket, avoid that bracket, and then pull the money out just a couple of years later at the lower bracket so that you can save money on the difference between the taxes you would have paid and the taxes that you will end up paying just a couple of years later, because you have more control over your income. And this is one of the ways that you can increase your after-tax return. That's the last thing I want to mention kind of for group number 2, right? So group number 1 was the high tax bracket group. Group number 2 was people who are very close to retirement, relatively speaking. Group number 3 is tight budgets. So if you're a person and you're in a tight budget situation, meaning that you either live paycheck to paycheck or you live pretty close paycheck to paycheck, right? Which I kind of define as within 5 to 10%, right? You don't have discretionary income of 5% of your total income, then you kind of live paycheck to paycheck. Every month is a little bit different. So Some months you may be right there, paycheck to paycheck, and then some months you may have a little bit of room, maybe $100, maybe $150, something like that. All of that kind of falls in this group. So if you consider the traditional 401k relative to your other options, if you're in the tight budget group, right, that's the third group, it is easier for you to save in a traditional 401k relative to after-tax options such as a Roth 401k or IRA or something like that. And the reason why is because, remember what I said earlier, is that when you contribute to a 401k, it allows you to put more money away than you otherwise would have been able to do if you had invested on an after-tax basis, right? So if you wanted to put $500 in the 401k, for example, right? First, you earn the $500 from your employer. In the traditional world, right, you earn the $500 from your employer. The $500 immediately goes into the tax-deferred traditional 401k. Now there's $500 in the 401k that can be used to grow your wealth over time, right? And how much did that cost you? Not $500, right? So your after-tax income did not decrease by $500, right? So you earned $500 ended in the tax-deferred account, but your after-tax income didn't decrease by $500, because if you had received that income rather than putting it in the 401k, you wouldn't have received $500. You would have received $500 minus the taxes you would have owed, right? So you're different. So when you invest in a traditional 401k or any pre-tax account, the after-tax burden is lessened than when you invest on an after-tax basis, right? If you had to invest $500 on an after-tax basis, you earn the money, then you pay taxes, then you take $500, then you put it in the account. And that's going to cost you more because you're not saving just $500 in that case. You're saving $500 plus the taxes you had to pay in order to receive the money in the first place. So in general, we'll have a video covering this specifically, how taxation works with all these different types of accounts and exactly what it costs you to invest in each one. But the general idea here is that you can, investing in a traditional account, in this case specifically a traditional 401k, will allow you to have more take-home pay that you can use to pay for your other bills. And so if you have to choose between investing a little bit of money in a traditional 401k for your future, or saying I have to invest on an after-tax basis, but you can't afford to do that and pay your bills, then a traditional 401k is a good way to get around that in the beginning and help you get the ball rolling, especially if you have a traditional 401k match or something like that. You can get your match on a pre-tax basis, which it'll be a little bit easier for you to hit that number relative to like a Roth 401k or something like that. So for people who are living paycheck to paycheck, or people who maybe just have a little bit of uncertainty in their finances at the time, it's good to give yourself a little bit of extra meat on the bones in your paychecks by contributing to your retirement via a traditional 401k. So that's group number 3, is people who are in very tight budgets, who maybe can't afford to invest on an after-tax basis but still want to make an impact. And last but not least, a special group that benefits, number 4, people who specifically want to lower their incomes. Now you say, well, that kind of sounds like group number 1, right? Group number 1 was you want to avoid high tax brackets. So the motivation of these two groups is different, right? Group number 1 is trying to avoid taxes. Group number 4, which is the I want to lower my income group, has a slightly different motivation. So let's break it down. So group number 1 is focused on avoiding taxation, and they do that by lowering their income artificially by deferring income into a 401k. Group number 4 is saying, I want to lower my income so that I can get something that I otherwise would not be able to get if my income was higher. So their motivation is not necessarily about taxes or avoiding taxation. It's about being able to qualify for some benefit. So it's common knowledge at this point that there are a number of government benefits that a person that is income dependent, right? Many government benefits, some of them are income capped, but some of them are income dependent, meaning that the amount of the benefit that you get is based on your reported income to the IRS. But for a lot of those programs, they don't necessarily look at your gross income. They look at another income called your AGI, your adjusted gross income. So your adjusted gross income is, it's a whole kind of convoluted thing. The U.S. tax system is not necessarily a simple thing. But the main idea is adjusted gross income is, for the sake of this particular conversation, we'll have another video on adjusted gross income and how it works and how you calculate all those numbers. But the general idea is that your adjusted gross income is your gross income, which is your total amount that you earn for the year, minus the monies that you would put into a tax deferred account like a 401k. So let's say your income is $60,000. You put $5,000 in a traditional 401k, so that's $5,000 of deferred income. So then your AGI in this very, very oversimplified case, right, would be 60,000 minus 5,000, so it would be 55,000. So a lot of government programs and a lot of other programs, honestly, they look at adjusted gross income, which could be lower than your gross income if you have deferred compensation in the form of a 401k or some other pre-tax vehicle. And sometimes the government will look at that AGI and determine how much of something you qualify for. I'll give you an example. It's 2020, 2021, and the government sent out a number of stimulus checks to everyday citizens. And whether or not you received those checks was based on not your gross income. It was based on your AGI, your adjusted gross income. So I remember around this time, this was a couple of years ago, I seen some articles floating around on MSNBC Money, and people were writing about how their tax advisors were advising. They were saying, I want to be able to get this stimulus money, right, from the government, but my income is too high to qualify for it. What can I do? And so they're looking at the code. They're looking at the actual bill policy, right? And what they found is that the policy was looking at an AGI. It was like an AGI of like 75,000 or something like that. So let's say you're a person and you make 80 grand a year, which is a great income, right? But you want the $1,000 stimulus check. Now, under normal circumstances, you wouldn't get anything, right? Because there's a phase out after 75,000 where you wouldn't qualify to get that money. So in the normal circumstances, you don't do anything special with your income, you're going to get nothing. But let's say you take of your $85,000 income, what did I say, 80? I think I said 80. So let's say you're making 80,000, and you take 10,000 of that 80,000 and you put it into a tax deferred 401k. So your income was 80,000. So your gross income is 80. Your AGI is your gross income minus your tax deferred investment. So that'd be 80,000 minus 10,000. You put 10,000 in there. So that's 80 minus 10,000. That's 70,000. So now you are below the $75,000 threshold to receive that money. And so under normal circumstances, you would receive that $1,000 check and any other checks that the government would send out that you would qualify for if your income was below the $75,000 threshold. And it absolutely works this way. In fact, I'm going to see if I can find some articles for you from that time period explaining how this works, right? And just so that you can kind of see. So a pure motivation sometimes for people is that they can use a 401k or any traditional tax vehicle for that matter to artificially lower their incomes so that they can qualify for benefits of varying types. That's the one example that I can kind of think of off the top of my head, but there's many, and I find them all the time. So I do that is a kind of really special one, and I do kind of want you guys to be aware of cases like that. So that's your 4 cases, right? These are your layup groups, right? Unless you find yourself in very specific circumstances, if you find yourself in one of these 4 groups, the probability that you will be able to have substantial benefits from being able to contribute to a pre-tax 401k, if you find yourself in one of these 4 groups, is fairly high. So let's go through them one last time. High tax brackets. You want to avoid taxation on your inefficient income or your high tax bracket income. Number 2, you're very close to retirement, right? So that means that you can take out a lot of the tax uncertainty that comes with investing over long time periods or investing on a pre-tax basis. You can also get rid of the liquidity issue because you don't have to wait that long to take the money out. Group number 3, you're living paycheck to paycheck, or the budget is just really tight right now. Sometimes you can't put as much towards your retirement as you may want to, but if you invest on a pre-tax basis, you'll be able to continue to contribute to your retirement accounts relative to the amount that you'd be able to contribute on an after-tax basis, which could be zero, it could be nothing, but you are able to put a little bit away on a pre-tax basis simply because you don't have to worry about paying the taxes before you're able to start investing. And then lastly, group number 4, people who have some motivation for lowering their income for a specific reason. So those are your 4 groups. I'd like to thank you for listening around if you're still here, and if you found this content helpful or engaging, feel free to like, comment, subscribe. Let me know in the comments if you think that I may have missed one of the special groups, or if you have comments about any of the material in the video. If not, thanks for watching, and I'll see you in the next video.